Today's short video, I'm going to talk about actually real estate investing in general. And while this video really is for anyone, whether you are completely new and you just want to become a real estate investor, or you are an existing real estate investor, or primarily this video is most dedicated to the audience that are high income earners. The reason I say that is the reality is a lot of times high income earners are quite often successful real estate investors. This is because of the tax benefits associated with it. So basically, are you a high income earner and motivated to do something productive with the taxes that you pay? I'm not sure if you know, but real estate investing is not only one of the most effective tax saving strategies, but it also serves as a wealth building tool, and you effectively can fund your investments with other people's money, aka the bank's money. You can basically buy real estate with mostly bank's money and have rentals pay off the mortgage. Real estate investing is one of the best ways to build wealth due to tax benefits, active income and offsets, passive income and cash flow, equity and appreciation, and leverage. One of the main reasons that I say this video is for the high income earners is, number one, the taxes, but number two, the high income earners are actually the most likely, really the best candidate to get 30-year fixed mortgages. So that's why it is, something advantageous for them to consider. It really could be argued that real estate investing for high income earners is, basically the most effective tax strategy. Not only is it a tax strategy, but it serves as turning your tax liability into a scalable investment. And then you get the investment from the equity appreciation, or the asset appreciation, also then the equity appreciation, as well as, there's a chance that you might actually have some cash flow from that investment. Rather significantly, what happens is that you can effectively control an investment with really just a down payment, right? So if you are a high income earner and you already have a house, then you won't qualify as a first-time home buyer. But if you don't already have a house, you could potentially qualify as a first-time home buyer and put a lot less down as a down payment. But anyway you cut it, it doesn't really matter whether that down payment is 3.5% for a first-time home buyer, or it's 10%, or even maybe a little bit more than 10%. You still are controlling that investment with that down payment, and then you can get a loan for the rest. So while I'm not an accountant, and this is not financial advice, and I'm not a tax specialist, what I can tell you is that the IRS has three types of income classification. These are active, portfolio, and passive. So what happens is, obviously active income is from your job or your business, you're self-employed. And what happens is active losses can offset income, active income, or income from the active category, the portfolio category, and the passive income category. But here's the thing, is that portfolio and passive losses cannot wipe out active income, right? So what does that really mean? It just means that if you end up having passive income from real estate investments, it's not going to wipe out your, W-2 active income. Traditional rental income is classified as passive according to the IRS. So when I say traditional rental income or real estate income, what that really means is long-term unfurnished. However, there is a caveat with this, and what that caveat is short and medium-term rentals. So with short and medium-term rentals, quite often it requires more involvement from an owner. A lot of Airbnb investors, let's say, that just do Airbnb and short-term rentals, will consider a short-term rental something like 7 nights, 7 nights or something like that, right? Or less in some cases. I'm going to use medium-term in this video because I personally do and have done medium-term rentals for a very long time. So with respect to this short and medium-term rentals, in order to have this income be classified as active income, you must materially participate. So in order to materially participate, you have to, number one, you can spend more than 500 hours on the rental business per year, or you can spend more than 100 hours or more than anyone else, or substantially more than anyone else on the business. So if you own a short or medium-term rental, or you want to own a short and medium-term rental, and you meet this criteria, you have yourself a tax-saving monster. One little issue with that, and again, I'm not an accountant or a tax specialist or an investment advisor, but one little issue with that is that if you use the property more than 10% of the time, it then becomes classified as a residence. So you got to make sure that if you stay there, like if you're doing certain upgrades or whatever, and you're staying the night, that you just stay less than the 10%, which obviously that's less than 36 nights at the property. So here, even if you just do medium-term rentals. So this video is not really a short versus medium-term rentals video, but what I can tell you is I've done medium-term rentals for a very long time. I've also done short-term rentals for a very long time. And, you can, at least in my experience, where you can experience the greatest average monthly cash flow or average monthly deposits is when you combine medium-term rentals, 30 nights or longer, with short-term rentals from, let's say, May to September. And even if you want to do that, like short-term rentals from September all the way to May, I mean, you can, but the reality is that it is, it's just gotten very difficult and it's like very competitive. I think first got onto Airbnb back in like 2012 and all the way up until, really even 2024, it wasn't really that hard, but it's gotten very difficult, very difficult to compete with Airbnb. So if you really want to do that, to compete at that level and get those furnishings and, have that level of involvement, you can, but why not just push the easy button, right? I do medium-term rentals now, and it's pretty much most of the time people go in for 30 nights or 60 nights, and it's quite often a five-figure deposit, and it's and then quite often they also extend. So it's just exponentially less work than a short-term rental. But my point is that even with something like 6 to 10 rentals, let's just say more than 6 rentals, in a calendar year, for your taxes, it's really not that hard to qualify for 100 hours. If you think about the 100 hours, that is, basically that's less than 10 hours a month. And, you could be just doing certain things related to communicating with a property manager or communicating with different people that help you with the property, or anything related to, researching or shopping for furnishings or doing anything related to the property. It serves as certainly a very viable way for you to consider medium-term rentals as a real estate investor and not really having too much involvement, but still qualifying for that 100 hours per year. So there you go. There is your, tax idea for the day. If you like any of this content, if you are in a place where you like this rentals content, I have some links in the description. What you can do is you can click on the link, or also an email address. You can contact me if you're somebody that is, if you're interested in maybe speaking with somebody that's a little bit further ahead of you. I have something called an SMTR launch kit, short medium term rentals launch kit. Very inexpensive, and I also have a way to kind of work with people. Again, just very basic, simple coaching in various forms. So you go ahead and see those links in there. Also, you can consider subscribing to the channel or giving the video a like. And then you also, if you know somebody, maybe not yourself, but if you know somebody that might like this content, you can send it to them. Thank you. So while this video was mostly for high income earners, that are not real estate investors yet, it also does work if you're looking to get into real estate investing, and then also if you already invest. So if you already invest and you're not doing medium-term rentals, it's something to consider. One area that I've had a lot of success with, and again, I've been doing short medium-term rentals for 2 decades now. One area where I've had a lot of success actually is with what's called co-hosting. So co-hosting is just having lots of other co-hosts, and you can get on their sites, or they can help you with your direct listing, or they've got just their whole network, and then you can actually then get the listing from co-hosts. Make sure it's non-exclusive. But the other item that I did not bring up just yet is depreciation. So again, if you are a high income earner, even if you aren't a high income earner, it's something to keep in mind. So with depreciation, in case you don't know, is a non-cash expense. So what that means is, you don't pay anything out of your pocket each month or each year to get depreciation. You actually just get it. Like once you buy a rental property, or you are an owner of a rental property, or even a co-owner of a rental property, you'll get to depreciate that property. The IRS has their own little formula. Any sort of CPA or accountant would be able to calculate that for you. But it's basically, they just depreciate the property over usually 30 years, right? Just to give you an example, I have 2 properties that I own outright, and with those 2 properties, it's somewhere around like a little bit more than it's between $30,000 and $35,000 per year of depreciation that you get. The more properties that you have, the more depreciation that you will get. Again, a lot of the high income earners do enjoy real estate investing to get that depreciation, but it really serves as 3 things. Number 1, you get the depreciation, you get the tax write-off, and then you also are able to then write off all the expenses related to the property. So what that is all of the expenses, the gas to drive out there, the, propane for the hot tub, anything related to the water bill, the power bill, the mortgage, you can't write off principal, of course, but you can write off, the interest, the taxes, the insurance, any single, expense for the property, you can write all of those expenses off. Plus you get the depreciation. So it is, obviously a very big tax savings for you as a high income earner, or anybody that's is going to be a real estate investor. And then the other thing is potentially, clearly, the long-term wealth, right? So as you're paying the mortgage balance down and the property is going up in value, you're actually building your net worth. So you're turning your tax liability into a scalable investment. So you're increasing your net worth. And then the third thing is, of course, potentially profit. So I'm in a situation where I've had my properties a while, so they do cash flow very nicely. So I do experience that profit. But at the same time, because real estate prices are so high, especially here, I'm in California, in Southern California, you might not be in a scenario where you're experiencing a lot of profit, certainly right away, right? Especially if you're acquiring the property at a high price. But it's those 3 things: tax savings through all the expenses of the property, and depreciation, and then also you get potentially profit, and then you get one of the biggest kickers, of course, is actually increasing your net worth through the value of the asset going up. Thank you all very much. If you like this video or videos like this, consider subscribing to the channel, and give me a like. And if you have any questions, go ahead and put them in the comments. Thank you very much. Thank you for watching. If you like this video, or if you like this kind of content about investing, for the last several months, and quite often I'll be doing videos on real estate investing as well as short and medium term rentals, consider subscribing to the channel. Also, if you have any questions about medium term rentals or co-hosting or even short term rentals, feel free to drop those questions in the comment area. And also take a look at some of the links. So what I do is I have a link down there where I have a really kind of like an SMTR launch kit. So you can get that. It's going to kind of be different ways to do that over time. But you could also, email me, or you can kind of drop a comment here. If you'd like to email me, you can do that at socalrentalguy@gmail.com. And yeah, we could talk about, medium-term rentals or any co-hosting. I actually personally work with a lot of co-hosts, so it could be helpful in that area. Okay, thank you.